Welcome back, traders and advisors. We have traders and investors. We have Bob Brinker on the line. He is editor and publisher of the Brinker Fixed Income Advisor. He has been an editor and publisher of the Brinker Fixed Income Advisor since its inaugural issue in April of 2005. He puts out a monthly investment letter, covers a variety of fixed income related topics, including Fed monetary policy, U.S. Treasuries, CDs, muni bonds, no-loan mutual funds, and exchange-traded funds. You cover the whole gambit there, Bob. How you doing today?
I'm doing well. Nice to be with you.
Yeah, thanks for coming on. So, for what you do, you have to really pay close attention to interest rates and what the Fed is doing. So, let's talk about, what the Fed is up to with their monetary policy and its potential effect on the overall markets and especially the bond market.
Definitely. The way I think about the current policy right now, and the way they've talked about it in recent years, is to call it being incredibly irresponsible. Since the fiscal side of the House has been unable to really accomplish anything, the ball has been carried by the Fed in terms of trying to bail us out of the situation we got ourselves into a few years back. And so at this point in the game, it looks like most of what they've done has been able to turn things around and get the economy at least growing very, very modestly. I think probably looking at another sub 2% real GDP growth year this year. And every year they always say it's going to be 3% the next year and the year after that. But then as we get into it, it seems to come back down. So what credibly irresponsible means basically is that everyone has to believe that they're going to be willing to just continue to stimulate as much as they can with the limited tools they have. And they've done that so far. So I expect that now that we have most of the economic statistics that they attempt to target moving back in the direction they want them, they'll very slowly and very carefully withdraw that stimulative policy. But I would expect it to still take a few more years for them to return to anything close to what a normal policy might look like.
Okay, so you think that the tapering and all the effects that they're talking about being done, by October. You think that that's pure hogwash?
No, I think from the QE perspective, I would expect, as they said, that at the October meeting that will withdraw to zero. And so the idea of them continuing to add to the balance sheet will be over in October. I do think they'll continue to roll over the principal and maturing securities for some time. In fact, it seems like they've even revised in recent meetings or been talking about changing their next steps going forward. So I do think that they're going to look at possibly raising short-term interest rates using this IOER, interest on excess reserves, probably a couple times into next year, while continuing to maintain the level of the balance sheet near the $4 trillion level that it got to.
So you think they're just, after pumping all this money into the economy, you think that they're going to be able to reverse course and do it in a slow enough fashion where it's not gonna rock the apple cart?
Well, I think they're going to try. I think that the risk to being incredibly irresponsible, right, which basically means keeping the foot on the gas for longer than the data would otherwise say you need to, right? They've committed to doing that. They've said, extended period of time, long after things have improved, we're going to keep policy. So they're promising to be irresponsible with policy for a while so that they can reach that trajectory they need the economy to reach to be self-sustaining. So that sounds good, and it's probably the right policy from an academic standpoint. But the details of actually managing it are going to be quite difficult, and I think that the real risk down the road, but they have to take this risk because of the fiscal side of the government just isn't working, so they really have no choice but to take this risk. But the risk would be that things can run out of control, and you're already seeing signs of it in credit markets where there's just no such thing as high yield anymore. I mean, high yield today is 4 or 5%, right? So there's no such thing as very risky paying debt instruments. The only way you can get there is by using leverage or some other, unwanted feature of a bond. So that's the risk, I think, is that things can just get outside of their control again, and that's what happened in the past. So I do think that's a real risk, but it's not showing up yet, right? So you have to ask yourself, well, where is it going to show up first? And so, we try to do that. We try to look at places where you would expect to see the problems emerge, and there's certainly early signs of them, but they're not rampant or a threat yet. So we'll see how it plays out over the next few years, but it's not going to be a piece of cake for them to just ignore this economic data for too long. It's going to be harder and harder, and the vocal critics are already coming out now saying they're already behind the curve. Just wait till the middle of next year and see how loud that chorus gets.
So you're not impressed with the job that Janet Yellen's doing so far then?
No, I wouldn't pin this on Janet Yellen. I mean, she's no, I wouldn't be critical of her. I think that, like I said, I think not the monetary policy, but I think they have to attempt to achieve price stability and maximum employment. So they're doing their mandate, what they're set up to do. The problem, I think, is that the fiscal side has been unable to do anything to support them, and so they've had to do more than they otherwise would have wanted to do. But I wouldn't blame them for being the only ones willing to do something. I think they're doing the right thing, but that doesn't mean it's going to work,
I have to agree on that. Now, I'm looking at some of the topics that you talk about are certificates of deposit. Are those still around?
They are. There's not a whole lot of rate on them anymore. I mean, if you can get 2 to 3%, you're doing quite well. But on the other hand, at least you have a date certain maturity where you're going to get your principal back and you're going to collect a tiny interest rate. I guess the plus side to the very low rate is at least you're not really, or at least in recent years, you really haven't had any inflation to eat away at the purchasing side of it. So although the rates are real low, the nominal rates, that's really all you can get. And that's an effect of this policy that we were just talking about. I mean, that's really all you can get if you want to guarantee the return of your principal.
And with inflation, I mean, you're basically breaking even, right, at that level with the CD?
Well, today, I would say in the last 2 months, inflation has ticked back up a little bit. I mean, for the last 2 years, inflation's been running at basically near the lowest rates in the history of the country. So there's been no inflation for a few years. But yes, now more recently, as it's picked back up because the policy has worked. Okay, I mean the credit to getting inflation to turn back higher really goes back to what we were just talking about. But now that inflation has turned back up and the disinflationary trend has ended, now it is going to start eating into those yields. And you say to yourself, well, what's the effect of that? What are people going to demand as inflation turns back higher? Well, they're going to demand a little bit more yield, and so that's where this cycle really begins, right?
And, let's talk a little bit about muni bonds here. I mean, here in Detroit, you had the bankruptcy, and, some people are coming out okay. Some people they're not, obviously investing in municipal bonds for tax reasons. Is this, do you still feel that these are solid investment vehicles, and no matter what the Fed does, that the muni bond market's pretty much immune from collapse?
Well, I think you really got to be careful with muni bonds. I think there's definitely a purpose for them. I think so you have to understand what they're for, right? I mean, they're for predictable tax-exempt income. I like muni bonds for two different sets of investors. An investor who lives in a state is in one of the higher tax rates. So if you're in, say, California, muni bonds have been a slam dunk the last few years as the budget has improved there. So you can earn, and tax rates have skyrocketed there, right? I mean, I think they have I can't remember, but 11 or 13% state income tax rate on top of a 40-some% federal rate. So, if you're a high tax investor in California facing over 50% of your income being confiscated, then Sure. I mean, a general obligation bond from the state of California has been a great investment for you the last few years, even with rates relatively low, because the credit ratings have improved. Now, if you're a resident of Detroit, you might not be so thrilled about being a muni bond investor holding a Detroit general obligation bond. So, yeah, you have to look at them where you are. The big thing, if you're going to get into the muni bond game, is to understand the municipality that you're buying from, the issuer. You want to have good demographics. You don't want to be in places where people are fleeing, like, say, Detroit or Puerto Rico over the last 10 years. They've had this exodus of people, or even longer than 10 years. Well, that's tough on municipalities, right? Because they have promises and commitments that are long-term, and they're trying to collect from a shrinking pool of payers, and it's just a bad dynamic. So I would say to, very solid, very large general obligation issuers, and you also want to hold them to maturity, in my view. The real benefit to being a muni bond investor is a lot like being a CD investor. You want to hold the bond. You have a certain date when you're going to get all of your principal back. So don't worry about the price fluctuations in between. Just buy them, hold them till they mature, and roll them into a new one. The other way I really like for most people to do muni bonds is through some closed-end funds. We got into a situation at the end of last year in December where many of the closed-end funds were trading at, 10% plus discounts to net asset value because of all of this stuff that's been going on in the muni market, and because of the rate spike last year. So you could pick up a couple of closed-end funds at huge discounts to net asset value, and they've all recovered nicely this year, and there's still, I think, more in that recovery over the next year or two.
Okay, and also you do some commentary on no-load mutual funds and exchange-traded funds. Boy, a lot of connotations associated with those two things. Just general comments on both of those.
Yeah, I mean, we really focus on the individual retail investor with our investment letter, and so we do like using no-load mutual funds, low-cost no-load mutual funds as a tool or a mechanism for establishing your investments, just because it gives you broad diversification, daily liquidity. It lets you really own a large basket of securities at a very low cost. So we use those for that, from all the major names that everyone knows, from folks like the Vanguards and Fidelities and T. Rowe Prices of the world. The exchange-traded fund space, we've certainly paid more attention to it recently, and a lot of our subscribers like that because they like to be able to do things throughout the day or find a specific area, and also they keep costs extremely low. So for most of the ETFs we follow, once again, they're just new branches off of those no-load funds. Like a company like a Vanguard will offer an ETF version, but all the money gets pulled into the same, basket of securities.
Okay, and to end the interview, Bob, I noticed that you started your inaugural issue of your fixed income advisor in April of 2005. So you got a good start headed in, to the financial crisis. You obviously survived the financial crisis very well and come out with a great 5-year track record. Are you seeing anything in the markets now that's symptomatic of things that happened back in 2008, 2009 that would give you a cause for concern? Because the market in 2008 was riding up, everyone was fat and happy, and then the credit crisis came. Do you see anything in the stuff that you found in the credit markets that would tell you that we're really in an excessive bubble here and things are about to change?
I wouldn't say anything quite like that. I think the area where you're starting to see that begin to happen would be in the high yield space. I mean, you're seeing a lot of alterations to the high yield securities that are coming out that are non-investor friendly. So that's not an area where I think you're getting paid for the risk you're taking. I mean, you're getting a little bit of extra yield. And obviously defaults are very low, and I expect those to stay low. But I just don't think that the compensation they're willing to pay you for the changes they're making to those securities are worthwhile. So I think that's the one space where I'd be real hesitant to add money to at this point.
Okay, Bob Brinker, editor and publisher of the Brinker Fixed Income Advisor, talking about the Fed, muni bonds, monetary policy, all this important stuff that traders and investors should pay attention to. Bob, thanks for taking time out from your busy morning to come on, and we'd like to have you on again.
All right, thanks a lot. Good luck to you.
Okay, thank you.